Welcome to the StarseedFX. Today, we will discuss the very first thing you must learn and master in trading, that is, market structure. Market structure is the king in the world of trading. It doesn't matter what financial asset you trade, be it Forex, indices, commodities, or stocks. To trade the market successfully, you must master the market structure. Market structure is the foundation of price action, and price action is the market language. By understanding market structure, you can identify the trend direction and potential trade areas. That's why it's crucial to understand the general concept of market structure because it will link to the smart money concept strategy and make it easier to decide on market direction and who is in control, whether the buyers or the seller. All right, let's get started because I'm feeling bullish about this video. Feeling bullish. There are three different types of market structure: a downtrend or a bear market, an uptrend or bull market, and a sideways market or consolidation. What I'm showing you here is a theoretical framework of market movements because the market in real life rarely moves so smoothly to the downside or upside as one line like this. The market moves more complexly, usually with a substructure or minor structure. Now, let's focus on the theory of how the market moves. And later in the video, we will also quickly exercise how to read the market structure in actual market. You know, there are always highs and lows regarding market movements. And since this is an advanced course, I assume you already know the difference between lower high, lower low, higher low, and higher high. So now let's focus on a downtrend or bearish structure. The market is downtrend when you see a series of lower highs and lower lows. The market pushes to the downside and creates a pullback or correction before continuing to push to the downside and create a break of structure. These lower lows and lower highs will continue until the market is exhausted and then reverse. Now, remember this, to define whether the market is in a downtrend, you should look for the break of structure to the downside. This lower high is valid once there is a break of structure to the downside. If there is no break of structure to the downside from the last low, there is no lower high. If you see movements around before the break to the downside from the last low, those are substructure or minor structure. Now let's focus on an uptrend or bullish structure. The market is at an uptrend when you see a series of higher highs and higher lows. This movement is when the market pushes to the upside and creates a pullback or correction before continuing to push to the upside and create a break of structure. These higher highs and higher low will continue until the market is exhausted and then reverse. To define whether the market is in an uptrend, you should look for the break of structure to the upside. This higher low is valid once there is a structural break to the upside from the last high. If there is no break of structure to the upside from the last high, there is no higher low. Any movement around or zigzag before the break to the upside is substructure or minor structure. Now that we understand how to identify bull or bear trends, the next step is understanding the multi-timeframe level of market structure, also known as minor or substructure. We must learn how to dissect a bear or bull trend on a higher time frame and understand how its components apply fractally down to the lower time frame. For example, the black lines represent the daily chart, which shows an uptrend with higher highs and higher lows. We would expect to see the same on a lower time frame. However, we must recognize the fractal nature of markets and understand that we will also see lower lows and lower highs as pullback occur on a higher time frame. So when prices make higher highs and higher low in a higher time frame, but on a lower time frame, such as the orange line, prices can create lower highs and lower lows during a pullback. This means that we should expect lower time frame to show a different series of lower highs and lower lows, which is the opposite of the higher time frame. Remember when I said earlier that the market in real life never moves so smoothly to the upside as one line like this? The market moves more complexly with a substructure or minor structure. So it is possible when the primary trend is up or bullish, but you decide to sell because you see a break of structure to the downside. This is called a counter trend or trading against the trend. The question is it okay to trade it? Of course you can, but you cannot expect a high risk-reward ratio from a counter trend. I know many beginners get dizzy looking at the market substructures because they are trying to keep up with all the twists and turns. Now let me quickly explain the difference between impulse and pullback. The primary direction of the main trend is known as impulse or continuation. At the same time, a pullback is a market correction, also known as a retest or retracement, that occurs before the trend continues in the main direction. As I mentioned in the previous video, many terms used in trading refer to the same concept. We all know it was all just trading semantic, but hey, variety is the spice of trading. Here's a quick example of how to read the market structure in the real world. For instance, an uptrend is characterized by a series of higher highs followed by higher lows. This is confirmed by the break of structure to the upside that indicates a low point to be a higher low, and so on. As you observe the market, you will notice that it never moves in a straight line. It always moves with a substructure or minor structure, sometimes in more a complex way. Therefore, it is important to differentiate between a primary structure and minor one. Now, here is an example of a downtrend. You see a series of lower lows followed by a lower highs. This is the break of structure that confirms this high to be a lower high. The break of structure to the upside confirms a high point to be a lower high, and so on. And this is an example of sideways market, where you see equal highs and equal lows. Well, actually not really equal. So this is relatively equal highs and relatively equal lows. One of the main components of the market structure is the break of structure. A break of structure is defined as the point where the price breaks and closes above or below the body of the previous candle. This approach is considered the most conservative way of mapping out the market structure and identifying break of structure. Alternatively, a break of structure can also be defined by the price breaking and closing beyond the previous candle's wick, which is considered the most aggressive approach. We will delve deeper into this topic in future videos, but it is essential to understand the basic for now. To fully master the concept of trading smart money, you must study and master market structure chart. It may take some time to recognize between the main and minor structure if you are a beginner, or to define a lower low, lower high, and higher low. However, with practice, you will get there. But now you know why the Forex trader went on a date with the market structure, because he heard it had a lot of support and resistance. You know, some Forex traders quit their day job because they found their true calling, staring at the chart all day. Anyway, if you have any question or feedback about this video, please leave them in the comment section below. I always appreciate hearing from you. In the next video, we will explore how to define a swing high and a swing low correctly and the trends that change or market reversal. Thank you for watching, and I'll see you in the next video.